What is happening in the markets? Get ready, because the Bitcoin Bulletin is bringing you the absolute latest, the most crucial updates you need to know right now. We're diving headfirst into a week where bulls are facing a massive test, trying to push nearly $1 billion into ETFs and avoid a historic downturn. Plus, we've got a major player in the gaming world making a colossal bet on Bitcoin, signaling a seismic shift in corporate strategy. And in a move that's got everyone talking, BlackRock CEO is back with his take on Bitcoin's role in our financial future, comparing it to digital gold and diving deep into why our national currencies are losing value at an alarming rate. We're breaking it all down live. You do not want to miss this. Stick around, you're about to get the intel you need to navigate this wild ride. Let's go. The ETF gauntlet begins. Bitcoin bulls are staring down a monumental challenge this week, tasked with the critical mission of funneling close to $1 billion into US-listed Bitcoin exchange-traded funds, ETFs. This isn't just about market sentiment. It's about preventing these institutional investment vehicles from registering their second-worst performance on record. Remember back in January 2024, when 11 spot Bitcoin ETFs launched on the Nasdaq, opening the floodgates for investors to gain exposure to the cryptocurrency without the hassle of self-custody. Since then, these funds have collectively raked in an astounding $53.9 billion. But this month has seen a dramatic reversal. We're talking about a net outflow of $972 million so far, making it the second largest outflow since their inception, surpassed only by the massive $3.56 billion outflow in February. If Friday closes with another negative tally, it will officially break a 4-month streak of continuous inflows. Analysts are pointing to this slowdown in ETF uptake as a primary driver behind Bitcoin's lackluster price performance this month. After hitting a record high of over $124,000 earlier in the month, the spot price has retreated to just over $100,000. Matrixport highlighted this trend, noting that this month's potential outflows could be the second highest on record, a stark contrast to February's peak. They advise caution, suggesting that while seasonal headwinds might be temporary, they serve as a crucial reminder that flow dynamics and seasonality are paramount. The prevailing sentiment among experts is that Bitcoin is still poised for growth, with projections hinting at levels exceeding $150,000 by year-end. However, this optimistic outlook hinges on substantial capital inflows. Marcus Thielen, founder of 10x Research, emphasizes that while the macro narrative is important, sustained price appreciation requires tangible capital. To hit that $150,000 mark, Bitcoin would need approximately $404 billion in total inflows this year, an additional $173 billion from now until December. That's a staggering figure, double the combined allocations from Bitcoin ETFs and MicroStrategy since the start of 2024. On a brighter note, Ether ETFs have seen a strong performance, registering a net inflow of $3.23 billion this month, continuing their winning streak since April. But what does this mean for the average investor? And what's the next big move in the crypto space? Stay tuned, because we're about to explore a major gaming company's bold Bitcoin strategy. Gaming giant goes all in on Bitcoin. In a move that's sending ripples through both the gaming and crypto worlds, Boyaa Interactive International Limited has significantly bolstered its Bitcoin holdings, acquiring an additional 290 BTC for approximately HK $257 million, $33.91 million. This strategic acquisition, made through open market transactions between August 5th and 25th, 2025, was funded entirely by the company's internal resources. This latest buy brings their total Bitcoin reserves to an impressive 3,670 BTC, acquired at an average cost of $62,878 per coin. This represents a notable 12% increase in the company's Bitcoin holdings per 10,000 shares, now standing at 0.0516 BTC per 10,000 shares. This isn't just about accumulating a digital asset. It signifies Boyaa's definitive pivot towards a Web3-driven business model, with Bitcoin now serving as a cornerstone of its corporate treasury strategy. The transaction, which necessitated a special disclosure due to its magnitude, underscores the company's commitment to integrating digital assets into its core operations. This aligns perfectly with a broader industry trend where public companies are increasingly allocating their treasuries to cryptocurrencies, viewing them as strategic financial assets amidst global market volatility and the relentless pace of digital innovation. Boyaa now joins the ranks of major players like MicroStrategy, which holds a staggering 632,457 BTC, and MARA Holdings with 50,639 BTC. Even more recently, Strategy added 3,081 Bitcoin to its reserves, while Metaplanet acquired 103 BTC within a single week. Boyaa explicitly frames these Bitcoin acquisitions as foundational to its Web3 transformation, viewing the cryptocurrency not merely as an investment, but as an indispensable resource for future growth within digital ecosystems. They highlight Bitcoin's limited supply and burgeoning institutional adoption as key factors creating a competitive landscape where early accumulation provides a significant strategic advantage. By expanding its Bitcoin reserves, Boyaa aims to cement its position as a leader in integrating blockchain technology into the gaming sector, utilizing Bitcoin to power decentralized platforms, facilitate tokenized rewards, and foster user-driven economies. This bold step also reflects evolving shareholder expectations and corporate governance, especially evident in Hong Kong, where the transaction required specific disclosure protocols. Despite these regulatory complexities, Boyaa's stock has seen remarkable performance, soaring 78.42% year-to-date, with analysts maintaining a buy rating and a price target of HK$8.50, citing its increasing Web3 exposure as a primary growth catalyst. The company's strategy of linking per-share metrics to its Bitcoin treasury could well set a precedent for other corporations venturing into similar digital asset treasury management. It's clear that major shifts are underway in how corporations view and utilize digital assets. But how does this compare to the insights from one of the titans of traditional finance? We're turning our attention to Larry Fink and his latest perspective on Bitcoin's place in the world. Digital gold versus national currencies, Fink's take. Larry Fink, the influential CEO of BlackRock, has once again weighed in on the cryptocurrency conversation, reigniting the debate over Bitcoin's fundamental nature. Is it primarily a currency for everyday transactions or a robust store of value? Fink's clear stance is that Bitcoin functions as digital gold, rather than a direct substitute for national currencies. He articulates that people are drawn to Bitcoin during times of economic uncertainty, when they fear for their country's stability or the devaluation of their national currency. This sentiment is particularly relevant when considering the persistent inflation eroding the purchasing power of fiat money. Fink points out that $10,000 invested in 2015 would only buy goods worth $5,980 today, representing a nearly 40% loss in value over a decade, even for a relatively strong currency like the US dollar. The situation is far more dire in countries experiencing double-digit or even triple-digit inflation, where Bitcoin offers a potential hedge against rampant currency debasement. He posits that Bitcoin represents a revolutionary democratization of financial protection, stripping away the exclusive privilege previously held by the wealthy to benefit from inflation. Unlike traditional, rare assets like luxury real estate or fine art, which often require substantial capital to access, Bitcoin can be acquired in smaller denominations, making it accessible to a broader population. Fink argues that Bitcoin's true innovation lies in its technological breakthrough, a liquid asset with an absolutely finite supply, a characteristic absent in physical assets like real estate or unique art pieces. This finite nature, coupled with its accessibility, allows individuals to protect their savings from inflation starting with even the smallest amounts. Fink's reservation about Bitcoin replacing national currencies stems from the inherent nature of modern economies and the role of central banking. He acknowledges that national currencies continue to devalue, citing the soaring U.S. federal debt, which increased by $1 trillion in just 50 days, averaging $21 billion daily. The July 2025 deficit alone reached $291 billion, with public spending relative to GDP mirroring levels seen during World War II and the 2008 crisis. The U.S. debt has ballooned to nearly $37 trillion, or approximately $108,000 per person, a trend mirrored globally, including in Europe, where debt per French person stands at around 51,000 euros. This relentless money creation, with the U.S. money supply increasing by an average of 7% annually over the last century, outpaces economic growth, which has steadily declined. Fink suggests that the inability to generate sufficient growth to match money creation fuels inflation and drives the demand for assets like Bitcoin. While acknowledging Bitcoin's advancements, particularly the Lightning Network, which enables near-instant, low-cost transactions, he notes its current limitations in replacing the complex financial infrastructure of national banking systems. These systems, essential for funding large-scale projects like nuclear power plants or satellite constellations, rely on the ability to create and destroy money, a concept known as fractional reserve banking. This elasticity in money supply, Fink argues, is critical for economic functioning and long-term investment, a characteristic inherently absent in a fixed-supply asset like Bitcoin. Therefore, Fink concludes that two currencies are necessary, one for investment and saving Bitcoin, and another for the day-to-day functioning of complex economies, national currencies. Bitcoin's success, in his view, does not hinge on replacing national currencies, but on serving as a vital store of value and a hedge against inflation. So, while Fink sees Bitcoin as digital gold, what about the companies actively building their future on its foundation? We're diving into the latest moves by a major gaming firm that's making a significant Bitcoin investment. Navigating the Fed's tightrope and geopolitical winds. The financial landscape is currently a complex tapestry woven with threads of central bank policy, geopolitical shifts, and the ever-present influence of historical political eras. For Bitcoin and the broader cryptocurrency market, these factors create a precarious environment where volatility is not just expected, but a defining characteristic. On one hand, the U.S. Federal Reserve's monetary policy decisions, particularly concerning interest rates and quantitative tightening, cast a long shadow. Any hint of a hawkish stance can trigger immediate sell-offs in risk assets like Bitcoin as investors retreat to safer havens. Conversely, dovish signals or expectations of rate cuts can inject optimism and fuel price rallies. The market is in a constant state of analyzing Fed communications, searching for clues about future policy direction. This sensitivity means that even minor shifts in economic data, such as inflation reports or employment figures, can have an outsized impact on Bitcoin's price. Beyond monetary policy, the echoes of past political eras also play a role. For instance, discussions around trade policies, tariffs, or shifts in international relations can create economic uncertainty. Uncertainty often drives investors towards perceived safe haven assets, and while gold has traditionally held this mantle, Bitcoin is increasingly seen as a digital alternative. The narrative of Bitcoin as an inflation hedge and a store of value gains traction during periods of geopolitical tension or when traditional financial systems show signs of strain. Furthermore, the potential impact of policies enacted during specific political administrations, such as those that might favor or restrict digital assets, adds another layer of complexity. Regulatory clarity, or the lack thereof, remains a critical determinant of institutional adoption and market sentiment. Companies and investors alike are closely watching for regulatory frameworks that could either foster innovation or impose significant constraints. This dynamic creates a challenging environment for forecasting Bitcoin's trajectory, as it's influenced by a confluence of macroeconomic forces, policy decisions, and the evolving global political climate. The market's reaction to these diverse stimuli is often swift and dramatic, underscoring the need for a nuanced understanding of the interconnected factors at play. Analysts are closely monitoring how these elements interact, recognizing that Bitcoin's price action is a direct reflection of the broader economic and political currents shaping the global financial system. The interplay between fiscal policy, monetary strategy, and geopolitical stability will undoubtedly continue to dictate the market's direction in the coming weeks and months. As we navigate these complex economic currents, it's clear that institutional adoption and the fundamental role of Bitcoin are hot topics. Now, let's hear directly from one of the biggest names in finance about his views on Bitcoin's future. And that's a wrap on today's explosive Bitcoin Bulletin. We saw ETFs facing a major inflow challenge, a gaming giant making a huge Bitcoin play, and Larry Fink doubling down on Bitcoin as digital gold. Don't miss out on any of these critical updates. Hit that like button if you found this valuable, smash subscribe to join our community, and ring that notification bell so you're always the first to know. Follow us on all social platforms for even more real-time insights. We'll see you in the next one.